Hey, everybody, welcome to the Spartan Storage Fund offering webinar. We wanted to thank you for joining us this evening, and we appreciate you taking the time to spend a few minutes to go through the 6 assets that Spartan Storage Fund 1 has purchased. Tonight, we're going to talk about how they're performing, how the investors are benefiting from the fund, why we love investment in self-storage, and also just kind of the way forward with the remaining shares that we have available in Spartan Storage Fund 1. So without further ado, we wanted to get our disclaimers out of the way. We're not offering any legal, tax, or investment advice, so please do your own due diligence on the investment. And this is just a general overview. So for any tax or legal questions that you might have, please consult with your tax and legal team. We are not CPAs, we're not accountants. So please consult your professionals on that. And this is, again, just a general overview. If you'd like to see all of our offering documents, underwriting files per property, or for the fund rolled up all together, you can visit our data room that's on our investor dashboard by going to spartan-investors.com. You can log in on the top right. You can see all of the documents surrounding the investment. And if you have any questions, feel free to email us at investors@spartan-investors.com. We might have a couple of minutes at the end of the webinar to answer your questions, but likely we're just going to go ahead and just answer them via email, or we'll answer them in the Zoom webinar chat as we go throughout the offering webinar. So please type them in there. So I'd just like to go over the executive team here at Spartan Investment Group, who's behind the machine. Spartan's CEO, Scott Lewis. My name is Ryan Gibson. I'm the Chief Investment Officer. And then also Ben Lapidus joins us in the C-suite as the Chief Financial Officer at Spartan. This is your investor relations team. If you have any questions about this investment or any investments in general, you can always reach me. And of course, Ed, Ted, Lauren, and Roy are here to answer any questions that you have or service your investment or help you get onboarded into the Spartan team. A little bit about Spartan, if you don't know who we are. We have about 25,000 units of self-storage nationwide in about 12 states. We have 100 full-time employees that do everything from build the additional units to operate the properties directly. We hire all the staff full-time at the facilities, and we do the acquisition, disposition, corporate finance. We are a completely vertically integrated company, and we handle all aspects of the operation. And you can see at the bottom of the screen there, Free Up Storage is our national brand that we own and stood up that manages all of these facilities and that we have direct oversight of. SEM, the bottom right there, is our construction company that also does all the improvements at the property, everything from hanging a sign to building an additional unit. We have that all in-house. We've been part of the VET 100 for the past 3 years, and we have about $500 million under management of self-storage. We've made the Inc. 500 list the last 3 years in a row as being recognized as one of America's fastest privately held companies that is growing. And we've raised over $200 million of investor capital to date. And we're also the number 40th largest operator owner of self-storage in the United States. So we've been ranked by Inside Self Storage Magazine on the top operators list. And this is just kind of an overview of all of our properties nationwide. You can see from the top left to the bottom right, we focus in the high growth states, places like the Pacific Northwest, the Rockies in Colorado, key markets like Madison, Wisconsin, Heartland, Wisconsin in the Midwest. And then we're very heavily focused in Texas and throughout the Sun Belt region, again, where the population is going, where there's a rising tide economy. We want to be where the action is. So this is just kind of why we love self-storage. Over the past 30 years, this is a map of how self-storage has done with real GDP growth versus self-storage occupancy as an average. And you can see dating back all the way to 1987, when we had Black Monday and markets created over 30%. You can see GDP went way down, but the gold bar there, self-storage occupancy, remained steady. In 2000, during the dot-com bust, the GDP again cratered, self-storage occupancy remained steady. And then obviously the Great Recession of 2008, self-storage occupancy performed very well. And then obviously during COVID, when we saw a massive decline in GDP almost overnight, self-storage occupancy not only did so well, but also rents were up 12.7% year over year during COVID. So self-storage was easily the top performing asset class. And that's because self-storage depends on life events. People often think that self-storage is this thing that people have too much stuff and they're going to get rid of it as soon as something bad happens. It's just the opposite, where self-storage is dependent on life events. So the more disruption in the economy, the more moving, downsizing, relocation, job loss, job gain, that's when we actually start to really thrive and do really well as an industry. So Spartan Storage Fund 1, getting to kind of the brass tacks of what is in the fund. This started off as a $150 million fund that we have really slowed down because of the interest rate environment. We haven't bought as much this year, but the properties that we have purchased are high quality assets that are producing cash flow with fixed interest rate loans and really fit nicely to the targeted returns of Spartan Storage Fund 1. So when we set out, we were going to buy about $400 million, but we've only actually purchased just shy of $80 million this year. And investors that are thinking about putting their money into the fund now have the benefit of knowing exactly what's in the fund. Whereas, back in April, you may have not known what we were going to purchase. Now you can look backwards and you have the benefit of hindsight of having the assets that are already performing. This fund is already cash flowing, and you get to buy in at cost of what we paid for these assets. So without further ado, the first property closed in June. This is Havelock, North Carolina. This was formerly called Plaza Mini Storage. Now it's rebranded into Free Up Storage Havelock. What's great about this asset is we picked it up for $15.5 million. We paid all cash for it. We just got the appraisal back, and it was over $16 million. This is after we went into the interest rate environment that we're in, and the stabilized value next year, after we complete all of our rent increases, valued the facility in the appraisal at $18.3 million. So buying in at a great discount here, which is amazing. The next assets that we purchased was part of the Horizon Storage Solutions transaction. These are both outside of Louisville, Kentucky. These have been rebranded now to Free Up Storage Simpsonville and Free Up Storage Shelbyville. We picked up this transaction for $12.5 million. The next transaction that we purchased was closed on October 14th. And this transaction makes up two properties, one in Louisville and one in Bonita Springs, Florida, that are now rebranded into Free Up Storage Bonita and Free Up Storage Louisville. This transaction was about $22.67 million that closed back in October. And then lastly, Art Care Storage, which is in Chattanooga, Tennessee, where we already own 3 other properties, have a ton of economies of scale there. That is now rebranded to be called Free Up Storage Hickson. So you'll see that in all of our reporting. And we paid $13 million for that property. That property also appraised really well. So these were the 6 assets that are in the fund. So if you think about buying into a portfolio of self-storage, that's kind of what it is. And what we like is that all these places that we're investing are high growth markets, specifically markets like the Louisville property, where there's 8 times the national population growth surrounding the facility, or places like Florida, where it's the fastest growing state, the 3rd most populous state, and Bonita Springs is actually in the 2nd fastest growing county in that state. So we love the fact that these are in high growth markets and a rising tide for customer attraction to our properties. We also love that these have economies of scale with our other facilities. We don't have our other facilities listed here, but you saw on that previous map, we're pretty much all throughout the Southeast United States. So we're really getting strong portfolio composition. This is helping us with our economies of scale, reducing costs, driving down our expenses, raising our rents, and getting really good economies of scale with marketing and efficiencies, and just really having better eyes on the assets than if it was kind of a one-off deal. So economies of scale is great. And then also we're going to talk about tonight how we're buying these properties where the mom and pop owners really just haven't raised the rents to market. And we're getting a lot of really nice value added NOI growth just by bringing these rents up to the market rate. So we're really excited about that. So without further ado, we're going to jump right in. We're going to start south and then head north. And the first property that is already in the fund, this closed on October 14th, is in Bonita Springs, Florida. Now, if you remember, Hurricane Ian kind of came through just north of Bonita Springs to Fort Myers. Fortunately, Bonita Springs wasn't as impacted as the rest of the state. And the property itself, we've already had it inspected before we closed, and the property held up very well. It had very minimal damage, if at all. And so Bonita Springs obviously is in the southwestern part of Florida. 2nd fastest growing county, the Lee County, is in the nation. Our property has 29,000 vehicles per day. And if you think about self-storage, one of the main drivers of self-storage is visibility from the main road and then having that high traffic count, which we have here. It's got a very strong average household income, $141,000 a year, and then that perfect population growth number that we always look for in all of our assets, 2% annual population growth. This is the facility here. It's got that nice 3-story climate controlled and drive-up units available. We locked in a 5.48% fixed rate on this asset, and it came with 18 months of interest only, and then it amortizes into a 25-year fully amortizing loan. That is a fixed rate, so no rate caps needed. That is locked in. We got really great financing terms from a local lender, from Climate First Bank, which is in this market and has lent to us on another project. Again, Class A asset, great visibility from the main road. And the best part about this is the service that we can provide to the community of Bonita Springs. Specifically, in the month of October, we had 90 positive move-ins to the property. And that's because Florida just went through a disruptive event. Florida just went through a huge life event with Hurricane Ian coming through. And during life events, people need self-storage. So we actually saw over 90 net move-ins to this property last month. And this month alone, we've already seen over 40 net rentals come into the property. So we're really excited that we thought this property was going to take a little bit longer to lease up. It's already well over 93% occupied, and the extra cash flow that this property is kicking off is going to be beneficial now to the investors inside of the fund. So really excited about this asset, and it kind of serves as the crown jewel of the portfolio. Moving up to North Carolina, we're going to go to Havelock, North Carolina. And if you're not familiar with North Carolina, it's the ninth most populous state. It's home to a diverse economy. Specifically, Charlotte is home to 6 Fortune 500 companies. It's got a diverse banking economy. Raleigh has home to the tech centers of Research Triangle Park. And Havelock over on the east side is 20 minutes from Outer Banks, gets a lot of really nice tourism. It's got a military base right next to the facility, and it just gets a lot of nice traffic. It's part of the New Bern, North Carolina MSA. This property we've owned since June. We've already deployed a lot of the value add here. So we bought this property. We've already repainted it into our brand standards. That picture is an older picture there. We've already put up our signage. We've increased our street rates 75% since taking over. And occupancy has pretty much remained consistent between 92 and 95% since we took it over. So we're really bringing up the rents. And we purchased it all cash. And again, we studied the market. We looked at every single competitor around this property, and our average rents were 51% below the market rate rents. And all the properties that surround it were full. So when we raised the rents, really the customer had a decision to make, which is stay here or don't use self-storage. So we were seeing really nice attraction revenue growth at this property. And we believe we purchased the property at a 40% discount comparatively to another property that's traded just down the road. So we love this asset. This was our classic bread and butter property that Spartan purchases. It was a mom and pop owned facility. They'd owned it since the 80s. They sort of added on to it over the years. It's about 1,500 units, about 191,000 square feet. It actually has both exterior non-climate units, and then it has the climate controlled units, about 40,000 square feet of that. So really nice unit mix. And what I love the most, though, is that the seller actually hadn't raised some of the rent since the 1990s. So when we got in there, we flipped the tenants from an annual lease to a 30-day lease, which is way better for being able to adjust rents, and really just kind of cleaned up the property, gave it a light refresh. And this is kicking off a lot of cash flow. This is kind of our cash cow in the portfolio currently. So just really excited about this asset. Moving to Kentucky. Everybody loves Kentucky. It's the 25th most populous state. Louisville is where we focused most of our purchases in the fund, so giving us a great economies of scale. And you can see we purchased about 20 minutes or 30 minutes east of Louisville and Shelbyville and Simpsonville. And then we also bought another property in Louisville, Kentucky. Louisville is home to things like bourbon, horse racing, fried chicken, baseball, a lot of great things like the Kentucky Derby. But what I love most about Kentucky is, they've got some really central location in the United States, which is why UPS has been attracted to Kentucky, because it can access 70% of the US population within a 2-hour flight. So it's just a really nice, well-located state. And obviously, being the home of the bluegrass state, it has things like cattle farming, and not to mention fourth largest producer of automotive in the United States. So really nice diverse economy in Kentucky, and Louisville fits right into that. So surrounding the facility in Louisville, we have 8 times the national population growth rate. There's over 2,200 new residential units planned within a 5-mile radius of the facility. Average household income is super strong at 110,000. And the reason why that's important is we look at average household income as a measure of how much we can grow our rents. We typically see customers only able to afford about 3% of their household income a year. So we can measure that against the current rents and see that we have a major opportunity to grow our rates based on the occupancy of the property and the demographics in the market. So really excited about that. Again, 3 assets in Louisville. You can see Louisville, Simpsonville, and Shelbyville. This is some of the interior units at the Simpsonville property. Again, there's some climate and non-climate controlled units, giving our customers really great unit mix. And what's great is when we bought this property, obviously the seller had a loan in place, and that bank actually did not want to see these assets go away. So they actually redid the loan and reissued us a loan from the same bank, German American Bank. So we have a 5.26% interest rate on Shelbyville and Simpsonville. We bought those a little earlier in the year, so we got a better rate. But by the time we closed Louisville, rates started to tick up, as everybody knows. So the Louisville property has a 5.36% fixed rate. Great terms, 9 months of interest only, and then they roll into a 25-year fully amortizing loan. So again, fixed rate debt. There's no ambiguity about what the interest rates are going to be. We have a great opportunity to take advantage of the growing rent and the lower interest rate. Shelbyville and Simpsonville literally have no competition. There's no properties within a 5-mile radius of the Shelbyville property, which is great. 8 times the population growth. And what's awesome is that these properties are all co-located within 30 minutes of each other. So we can be really efficient with payroll and get scale in the market, which ties in nicely for a great exit strategy potential to a REIT where we collect up a bunch of properties, which I'll talk about later on in the webinar. And it just gives us that economies of scale that is very important in the storage industry. Next, we're moving to Chattanooga, Tennessee, home of the Chattanooga Choo Choo and a bunch of other things. Actually, Coca-Cola first bottling company was in Chattanooga, believe it or not. And Chattanooga is 4th most populous city in the state of Tennessee. And it's actually home to the fastest internet in the country. So this is kind of where the gig internet started. They have their own dedicated fiber lines and some of the fastest internet around. So we're very, very familiar with this market. We actually have 4 properties now in the Chattanooga market, and I'll talk about that in a minute. But adding this into the fund is a great complementary unit mix because of the boat and RV storage that this property also has available with it. So you can see on the Tennessee side, we have those 3 smaller pins, one up in Centerville, Tennessee, and then the 2 in Chattanooga. And then right across the Georgia border, we also have Fort Oglethorpe, which is about 30 minutes from this property. And then we also have a couple other assets kind of in Northeast Georgia. So a lot of economies of scale with those extra pins there. The big pin is the one that we bought for the fund. And again, great interest rate on this. Simmons Bank, who has done a lot of lending for us, gave us a 5.85% fixed rate. A great economies of scale. And what I love about this property, the picture here has a picture of the inside unit. So not only do we have climate controlled and exterior units, but we have boat and RV storage. And what's really neat is we have a property about 10 minutes down the road. And that property is called Free Up Storage Boy Scout. And that had boat and RV storage. But as part of our business plan, we were going to kick out those boat and RVs and expand that site by 10,000 or 20,000 square feet. My apologies, 20,000 square feet. That kicks off pretty soon. So all those customers, we're going to send them to our other property. So we actually have a way to kind of fill up the recently built boat and RV storage that was just built on this Chattanooga property. So we have a cornering of the market, economies of scale in Chattanooga. Really excited to be in this market and excited that this is part of the fund to which our investors can benefit. So just kind of overall, 6 assets in the fund. They're all pictured there on the screen with the unit count and the square footage. If you go into our dashboard, we've actually revised our offering memorandum. It gives you all of these stats and all of these properties that you can download. And you can see that we have Bonita Springs, kind of pride of the fleet, crown jewel asset. Havelock property gives us that cash cow, that cash flow. Kentucky has that limited competition surrounding it. And then obviously that really strong growth rate. And then we have a lot of scale in the Chattanooga market with free up storage Hickson. So really excited about these assets. There's really no duds in this portfolio. It's all nicely performing facilities. And we're just really excited about how the fund is purchased, especially as we go into an uncertain time. So the targeted returns to the fund have remained unchanged. Everything we bought has been individually underwritten to meet these target returns, and then feeds up into an overall underwriting file. So 15 to 20% annualized returns is what we project over a 5-year hold. This includes the cash flow that gets kicked off from the property, and then the sales upside that we share with the investors. And that basically breaks out to about a 5 to 8% per annum cash flow, 13 to 18% levered IRR, with a 1.7 to 2.2x multiple. Now, basically what that means is if you invest $50,000, we expect to get your $50,000 back in 5 years and another $50,000 on top of that. So we want to double your money in 5 years is our projection in the fund. This is kind of how it breaks out. Year one, we're kicking off about 4 to 6% cash flow. Year two, 5 to 7%. Year three, 6 to 8. And then year four, we kind of really dial in that 7 to 8% cash flow. We've seen, our track record, we've got properties that produce 8, 9, 10% cash flow after a couple of years, but we're being conservative in our estimates and where this fund will go. Current distributions. So we have been kicking off cash flow to investors that invested early on in the fund, and cash flow has been between 4 and 5%. So first month it was 5, last few months it was 4%. We don't anticipate this to trail off. We have great assets in the fund, and we expect this cash flow to continue. 30% of your investment is expected to be depreciated. So we're going to close the fund by the end of the year. And so anybody who invests in the fund gets the benefit of depreciation if they invest in 2022. So just a little bit more time, and you get 100% bonus depreciation in the tax year 2022. And as everybody knows, in 2023, it goes to 80, then 60, then it kind of phases out by 2026, 2027. So depreciation, you get this on a K1. You'll get your K1 in March of 2023. So we get all those out right away. Everybody gets one K1. There's not 18 K1s or K1s for each state. We don't do a complicated composite return, which, by the way, if you do a composite return, you don't get the benefits of depreciation sometimes in the state that you file. So you'll have losses typically on all these investments in the first couple of years, and you get that depreciation and you get one K1. So it's a really simplified process. So let's talk about how we exit, right? So we kind of view ourselves as being that kind of middle fish, right? So we're our exit strategy is to have options, right? You don't just want to have one sole shot exit strategy. You want to have multiple. And so this is just one way of looking at our exit strategy. When we kind of think of our portfolio size and composition, we kind of view ourselves as being kind of like a medium-sized fish. And we usually go buy and gobble up a lot of smaller fishes, like a lot of the mom and pops that we purchased in the fund, as an example, like Havelock, like Shelbyville, Simpsonville, et cetera. And someday we know that that the REITs or some larger institutional shops are going to be interested in swallowing us up. We're the 40th largest operator, but there's 39 larger operators, much, much larger operators than we are. And, just to name a few, they're up on the screen: StoreMart, CubeSmart, Blackstone, Simply Self Storage. Obviously, lots of bigger buyers that are looking for great portfolio composition that Spartan has, which serves as a great exit strategy for our investors. Now, I say all this, and sometimes I kind of feel like we're a big fish and we're getting chased after by a lot of little fish. There's a lot of people, a lot of mom and pop specifically, that want to get into this business. So while I think we just as much have larger shops trying to buy up our stuff, we're actually selling a property today. I think it's going to record and close today to one-off buyers, one facility transactions. And we have another one closing at the end of this month where we are making a great profit, and it's a one-off buyer. So as much as I'd like to say, one of the biggest options is to sell to a REIT, we can really trim off the assets that we can produce a ton of profit with and sell to one-off buyers. So really, we have multiple exit strategies. We've also done things like the properties have doubled or tripled in value, and we do a refinance and we send our investors money back many, many years earlier, tax-free, and they still own the asset, which is fantastic because really what we want to do is we want to get your money out of it. We've looked into equity recaps from larger institutional players. And then also we've done things like divide up the portfolio and sell assets off one by one, or spin off parcels and return capital back sooner than projected. So there's so many different ways, so many different options that we have. We want to keep our optionality open. And that's something that we really pride ourselves in. So when we buy these properties, what are we doing to really drive value? Well, we talked about buying under market rents. We've talked about some of the expansions that we do at these facilities, but really, we're going to repair the drive aisles, the roofs. We're going to renovate the offices. That's one of our offices on the right-hand picture there. Make it look really nice and modern, clean edges, cameras, safety and security. We're doing things that make the customer want to rent there and make their belongings feel secure, right? And well lit and not creepy, and really just a nice place to store their belongings. And that's what we do. Operationally, we do things like we rebrand everything into our Free Up Storage national brand. Like pretty soon that Go Store It sign from Bonita Springs, you're going to see Free Up Storage. And you're going to get things like enhancing the staff training and the customer experience. We have trainers at our staff. We have HR. We have regional district managers that help oversee a lot of the quality of our employees. And we do things like renovate the offices to provide a good retail experience. And we do business relationships and things like that with the community to drive ads to the property. But what I love the most is ancillary revenue streams. We actually charge tenant insurance to our customers, where we charge anywhere from $15 to $20 a unit per month. And we get to share 70% of the revenue that comes off the tenant insurance premium. So a lot of these mom and pops are not doing tenant insurance programs. We do a rev share with our tenant insurance provider, and it's a phenomenal way to drive cash flow and instant value to the property with very little minimal cost of goods sold. So really, really nice way to add value. So if you wanted to kind of dig into our data room, we welcome you to log into our investor dashboard. You can see things like the top right there, a full underwriting file for every single facility individual, and then also rolled up. You'll find things in there like feasibility studies, like Louisville, Kentucky. You can see I made a claim that there was 2,200 houses going through. So we list out what those housing developments are, how much drive-by traffic there is, the population growth rate, any new properties that may be popping up in the future. And so if you wanted to look at all those documents, you can see right there, we give you the PPM, Q&A, subscription agreement. All those documents are available on the dashboard. And then if you wanted to start your investment, you actually just click the button right above it. Click that. You put in how much you want to invest, and you can pick the entity you want to invest with. So if you wanted to invest with a self-directed retirement account or an IRA or under your trust, you make your individual account, but then you can add in entities that you want to invest with as well. So the next steps in the fund. Currently, you can go to our website, Spartan-investors.com. You'll see there on the top right-hand corner, you can log into our investor dashboard or investor portal. That's where you'll find the data room. That's where you'll be able to go in, log in, subscribe. You can get your funding instructions and all that kind of stuff. And but if you get lost in the process and you just kind of want us to dial in and help you through the process, you can always reach us at investors@Spartan-investors.com. We'll get back to you as soon as we can. And overall, kind of just where we are with funding on the fund. So we've bought all these properties. We've secured all that financing and all the equity financing to buy the properties. So now we're really just kind of topping off the fund. So we're bringing in a few million we probably have $1 or $2 million left to raise, and then we're going to close the fund. So if you wanted to participate, now is the time. This is going to be the last thing that we do this year. And if you wanted to really take advantage of bonus depreciation, you wanted to take advantage of cash flow, if you want to take advantage of fixed rate debt and the upside that we've already built, the sweat equity that we already have on these properties, we've been working on this all summer and all fall. You can join in, and you really get some of the same benefits that the investors had that invested earlier on in the year. Additionally, if you wanted to add incremental investments to your fund, you can just log in, and your investment will be over under my investments. I know a lot of people. We've actually had out of all the investors that invested, I think we've had like 30% add additional funding throughout the year. So if you wanted to go and add in, there's additional increments you can make of as little as $1,000 after you hit the minimum of 50K. And that will really kind of help that. So a couple other disclaimers too. This is open to accredited investors only. This is a 506c offering. So you can share this far and wide. You can generally solicit this offering, but you have to be accredited to participate. And you will be required to get an accredited investor certificate, which you can do on our dashboard for free, which is really nice. When you log in, it'll give you a link. You can click on that, and that will allow you to get your free accredited investor certification. Likewise, you can get one from your CPA, tax advisor, or financial planner. They just have to simply write that Ryan meets the definition of an accredited investor, sign it and date it, and be in good standing. So with that, we just wanted to thank everybody for attending tonight. Again, if you have any questions, feel free to reach out to investors at Spartan-Investors. I know many of you have asked questions throughout the webinar, and we've been able to answer those via chat. So that's been really great. But if you have any further questions or just want to know next steps, please reach out to one of our team members at that email address, or you can give us a call. But wanted to thank you again. For those that have already invested, thank you for investing. And for those that are considering an investment, thank you for watching. And we hope to catch you on the next deal. Thank you.